Do you need more money to keep your business afloat? This is Randy Kirk, and that's what we're going to be talking about today on Small Business Daily. I've got an amazing guest who knows a tremendous amount about refining your house in case you need more money to run your business. Matt, great to have you on today. This is Matt Rundle, and he is with Weston Mortgage. Matt, you've been doing this for a while. Tell us a little about your history in the mortgage business.
Sure. Well, Randy, thanks for having me on. I appreciate the opportunity to share all things mortgages on your show here. And been at the mortgage business for 30 plus years, lots of changes over the years, and enjoying the fruits of all the technology that's in the business available today. So what's available to our fingertips is amazing. So, but getting that content in the right direction is tantamount to, getting the best transaction for the client. So very dynamic time right now, and excited to be in the mortgage business. And just, we're capitalizing year after year with the knowledge and the connections with the clients and the loan products too. So, and again, thanks for having me on your show. I much appreciate it.
Sure. So I've many times in the course of my business life, I've needed more money. And quite frankly, many times I have tapped my home. So it is not unusual for small business people to be out there looking for more dough. And maybe they've already used up all the money that their dad or their grandma has. Maybe they've used up all their credit cards. Maybe they've talked to banks and the banks have said no. And they've maybe even gone into the non-bank lenders that maybe do accounts receivable lending or equipment lending or things like that. And they're just not finding the right avenue. But in today's market, sometimes the home equity should be the first place to go with these low rates. Matt, these are the lowest rates, like historically. Is that, right? We're at the lowest level.
Yeah, the rates have hit historic lows, and it's been great for the consumer to take advantage of that and basically reorchestrate their debt. Basically, we're assisting them to manage probably their biggest purchase ever being the home, but converting that maybe high interest rate 30-year term to a lower rate, a shorter term, it's made monumental changes. I think there's been changes that will like financially impact that household, that family forever in a great way. If you go from a 30-year loan that you've had for say 2 years, so say 28 years left, and you do a 20-year loan and your payments say essentially the same, maybe a little less, maybe a little more, but you got rid of 8 years worth of payments. That's 8 years that the industry cannot capture, but the homeowner has just eliminated that. So the low rates and the high equities with high prices have given consumers a great tool to leverage money. And I know you're talking about business people as another tool to look at equity. It is a great resource because it's probably going to be the least expensive way to access money if they want to put that money into their business. So it's a great topic that you're hitting on here. So I'm interested to hear more about your questions here.
All right. So, I'm maybe know a little bit too much about mortgages, but I'm going to ask it like I really don't. In the old days, we might have gotten a HELOC, but would you get a HELOC today, or would you just go directly to doing a refi?
Yeah. When we get questions like that, if Matt, I want to borrow, $20,000. Okay. Well, let's look at what is their interest rate. If they've got a great rate, they've got a great loan right now, there'd be no point to do refinance. It would be go to your local bank, go to your credit union, get a $20,000 HELOC. HELOCs, for the most part, they're offered at a super deep discount. Sometimes they're free. It's a great way to access money. A HELOC is going to be a line of credit typically, although you can get a fixed rate loan. But for a small amount of money, the HELOC is a great option to go. Now, if the client had a high rate and they wanted that $20,000, it would be prudent that they would incorporate that $20,000 in a cash out refinance to drop the rate, maybe shorten the term. So every situation's like a fingerprint. That's what's exciting about the business. Every deal is different. How much do you need? Matt, you need $5,000. Well, it wouldn't make sense to refinance and pay all the refinance costs to get $5,000. So everyone's situation is like a different fingerprint. Now, you reference business people. that might be a bigger need. They might need more money than a typical household. So the fun thing about the mortgage business, clients are presented to me on a daily basis, and everyone's got a different need. Is it a purchase? Is it a refinance? They need money out, rate and term. They're lowering their payment, lowering the rate. Everyone it's a journey. It's an opportunity to assist them. So it would be, again, if to answer your question, 20,000. What's your current rate? What's your equity situation? Does it make sense to do it on a refinance or do a standalone, a home equity line of credit that's an interest-only payment, or maybe it's a fixed rate second where they get all the money at once? You know, the home equity line of credit, if it's $20,000, they basically get a debit card and a checking account to access that funds. They only pay what they borrow, so it's sitting there. It's a HELOC would be like a credit card tied to your property. So a lot of options in the marketplace, and then to each person's couple, family, unique situation, kind of not tailor, but I'd say provide options to them. So, which is, again, that's the mystery, the fun part of our business.
Right. And so we have a situation right now where in some cases, maybe you would want to borrow the money against your equity now, even if you don't need it. A standard loan from a bank, if you have really, really good credit, is going to be several points above prime. So if prime right now is around 3 or 4, and you're paying a few points over that, you might be paying 6, 7, 8%. I've seen a few loan offers in the mail right now around 6 or 7%. So, but home equity, I mean, if you borrow against your home right now, Matt, talk about some of the rates that you're seeing right now. On this day, let's make it real specific, but what kind of rates are you seeing right now?
Yeah. Rates are going to run in the range on the 30-year fixed rate. They're going to be in the high 2%, 2 7/8 to the low 3%, 3 1/4. So by law, we got to quote a APR, but when we quote a range, we don't. So that would be the range on a 30-year fixed rate. We're talking conforming Fannie Mae, Freddie Mac. But again, every situation's different with respect to a buyer. You mentioned the HELOC, you mentioned a fixed rate loan. It could be such that someone says, Matt, I have equity. I want to have access to my money, but I don't want to necessarily borrow that money. We could do what's called a combination loan. Let's say we refinance the first trustee, drop that rate, maybe shorten that term, and combine it at the same time with a home equity line of credit. And let's just say they want to tap into $100,000 worth of equity. They could refinance the first, drop the rate. We would add a HELOC to that transaction. So when that transaction closes, they'll get their debit card, they'll get their checking account. It'll be essentially access to $100,000 tied to their property that they could use at their choice. They could go buy a car, they could use it for business. The beauty of a HELOC too is you can borrow against it, pay it down, borrow against it, pay it down. So it's basically a credit card attached to your property. And you do have to be careful. You can't go out to the hamburger joint and buy hamburger on your HELOC. You don't want to do that. You want to be prudent with it. But some households, some business owners have leveraged that tool to where it is inexpensive money and it's super accessible and it's easy to manage. So it's got some great attributes based on that consumer's needs. So if you're talking business, and it might be more difficult for them to access, a business owner to go out in the marketplace through a bank and access business funds, if they have the equity and they want to tap into it, that might be a way. And you mentioned they could do a refinance and have all that cash instantly, or they could tie it into where there's a home equity line of credit to it. So again, everyone's like a fingerprint, a different need. And when I talk to the clients, it's listen, use the 2 ears, listen, provide options, and let them make the best decision based on their situation. So, but you bring up a great topic for the business owner accessing equity from their home that might not be thought of, but it's going to be, I would say, less expensive than it would be on a business front, on a business loan. So, great topic.
Yeah. So now if you were using this HELOC approach as opposed to just completely refinancing and taking the cash out, the HELOC is going to be slightly more expensive than the first trustee, right? Yeah. Okay.
Correct.
So that would be a consideration into how they might do it, and they could, of course, take the money out and put it into some kind of a treasury. Well, treasuries don't pay anything right now, huh? But there would be a number of ways that they could take let's say they needed 100,000, they wanted to have this 100,000 in reserve. They could take the 100,000 out of the house, in a new first trust deed, they could squirrel that away into something that might be paying more than their mortgage is
Sure.
costing them, while they still have it liquid and available for the business.
Right, and that's again the beauty of being in the mortgage business as an originator on the front line, working with clients. Great, nice to meet you. Share with me, what are your goals? What are you looking to do? Matt, we're going to buy a house. We're looking to refinance, and then those questions, we go down that path and ask the questions to find out the needs of the client, then provide the options on that. So, when you mentioned $100,000 cash out, maybe they're doing a remodel, they're doing a room addition. Maybe they're, one of my clients, they've got kids in college. They wanted to have a nest egg of $50,000 just available to manage the college education, and they wanted to have it now, and they wanted to have it in their account just to have. They were cash flowing the tuition, but they wanted that as a cushion. So every situation is so different, whether they're self-employed and they could use funds from a business standpoint, or they're the homeowner that's looking to reduce the rate, or maybe access funds for home improvement, or say debt consolidation. So
Right.
it's, again, it's the beauty of the business.
Yeah, and it could be any of the above, or a combination of the above.
Sure.
That they might be interested in. And then, of course, if a individual takes out 100,000 or 50,000 for their business, and then they want to put it back in, they can always pay that mortgage back down again in a lump sum, even if they want to, right?
They could if they wanted to. Mm-hmm.
Right.
Yes.
And now, so let's say somebody's really we're not talking about somebody who's just doing it casually.
Okay.
Which usually, I know in my history, I wasn't usually borrowing against my house casually. It was usually an emergency situation.
Okay.
And let's say you want to borrow more than the 80%. Let's say you want to borrow the 90%. Can you still get cash out on a 90% loan?
Well, we're talking Fannie Mae, Freddie Mac guidelines. You can go up to 80% of the value, the appraised value for cash out. So, you have conventional Fannie Mae, Freddie Mac, you have FHA, you have VA, you have jumbo financing. So again, based on that client situation, we'd apply the guidelines and maximize what they can do based on their needs. So, there's guidelines. We follow them. We honor the guidelines. We maximize the qualifying. But for the example, if it's a conventional loan, they can go up to 80% of the appraised value, and that can be their loan amount. They pull that money out, and that money comes out. It pays off the existing loan. It pays closing costs, impounds, and they retain the net proceeds. They've got the new loan. Hopefully, they got better terms than they currently have. So, and again, it depends on what their desires are. But 80%. It depends what they owe. Could be a big chunk of money.
And let's say, for instance, that the rules at any given time say, nope, you're capped out at 80% on a first trust deed on cash out. Could they then turn around and potentially borrow another 10% on a HELOC?
Sure, they could. In fact, on that topic, we could do an 80% loan, and then a combination where the second trustee takes it up to 90%. So 80% of the first of the value, then 10% of the value. So 80, 10, they'd be borrowing 90% of the value. And again, that kind of goes back to everyone's got, we have these things called fingerprints, and everyone's finances, from their income to their credit scores, to their bills, to their ratios, to their property, to the value, all those, I call it matrix pricing, or you could say it's like matrix strategizing, because all those are important factors in how they're going to be able to maximize what they're looking to do. So they could be, Matt, I'm at 80%. The standalone seconds are typically done by independent companies, maybe credit unions, maybe banks are okay. Where if they want to borrow that 20, 30,000, my advice would be, where do you bank at? Where's your credit union? Who's on your cell phone? Go there and get it from that company, because they'll do the standalone. It's tied to your existing account. It's easy to manage that account. So again, it depends what their needs are. Someone wanting $10,000, $20,000, we look at it. Would it make sense to refinance? If they've got a great rate, absolutely not. We wouldn't touch that loan. We would not do it. It'd be bad advice. We'd say, you know what, go to your local credit union and get an independent home equity line of credit. I've got great resources through my connections that I can point people to if they wanted that. And again, it's doing the whole analysis and say, you know what, when it's all said and done, really all you need is $20,000. Let me get you connected with, I've got a couple associates that run HELOC programs here in Southern California. So the needs of the client is always the top priority. And it's fun when you focus on the solution, it always filters down to this is the best option for you. And again, there's some cases, Randy, you're all saying, you know what? The best thing to do is not refinance at all. I wouldn't touch what you got. Don't let anybody else do it. Leave your loan the way it is. The best loans I've originated are some loans that I haven't originated because they just weren't good for the consumer. So, and those are, you know what, surprisingly, those are super rewarding because the people are very appreciative knowing that what they have is a good product, not to touch it. So, but again, I'll go back to everyone's got these things called fingerprints, and they're so unique. Everyone's got a different situation. We didn't really talk about credit, but credit plays a lot with what they're trying to accomplish too. So that's kind of that full circle on when we work with a client, we're covering all aspects to help them obtain what they're looking to do at the hopefully best available rate. So great topic though. It's very interesting.
So yeah, so that was going to be the other part of the subject matter today, because most small business people are, if they're playing with the books at all, which we know no small business people ever play with their books, but no matter whether you look at it as being a legal way of keeping your income low, or whether you're playing with the books, most business owners are trying to keep their income low. But
Sure.
that, of course, is going to interfere with their credit availability. So how much in advance do people need to start maybe shifting their books to show more profit if they want to up their credit score in order to get a mortgage?
That's a great question, Randy. I haven't heard that question in a long time. So depends again on the type of loan they're getting. One of the benefits of, we're going to talk conventional. So there's three types of loan. There's conventional, there's FHA, and there's VA. On conventional, if you've been self-employed for more than 5 years and your loans run through the computer, you get an approval through either Fannie Mae or Freddie Mac, and you've been self-employed for more than 5 years, generally the approval will only ask for 1 year's tax return, your most recent tax return year. FHA and VA will require 2 years. Jumbo typically requires 2 years worth of tax returns. They want to see a 2-year history of your business, but Fannie Mae, Freddie Mac with 5 years plus, it generally defaults to just the most recent year. So if someone's going to strategically say, I make a lot of money and I got a good tax person, but I want to buy a house and they want to get the best pricing, they need to pay that. They got to honor. They have to honor the qualifying guidelines. They're going to need to, maybe have a higher net income from a qualifying standpoint, and there's just no way around it. The guidelines are there for a reason. They're there to protect the consumer. Probably, I think first and foremost, they're there to protect the investor. They're there to protect the agencies. But if the consumer's protected, then it's good, prudent business for the agency and the investor. The agency being Fannie Mae, Freddie Mac, FHA, VA, the investor being whoever buys that loan. It's good for our company with the consumer first. If they're protected, they fit within the guidelines, and we can be assured for the most part that they'll be able to perform and make their payments on time. So yeah, but if someone's self-employed and they're not showing an income, they would have to, if they don't have income to support qualifying, they would have to do a loan that would be maybe a bank statement loan or a private money loan. A bank statement's going to be 12 to 24 months of either personal or business statements. And there's formulas we use to pull out the income based on the business bank statements or personal bank statements. Those do have some popularity. There are business owners out there that have substantial revenues, and maybe they have a lot of expenses. They just don't show enough of a net income to qualify. And those loans are available for that particular segment of the population. They're going to pay a premium in pricing because the investors are using bank statements. They're not looking at tax returns. So that's, again, another neat thing about our industry is that there's a dish for every buyer. There's a entree for every buyer based on their needs. Let's say, Matt, I don't have any income, I got bad credit. Well, Fannie Mae, Freddie Mac, they're not going to lend because you don't fit the guidelines. These bank statement lenders won't lend. But you know what though? There's private investors out there with the right down payment. They will lend to you. Will the terms be great? No, they'll be high, but you're getting financing where you wouldn't get financing otherwise. So again, I think I've said it my fourth time now, the fingerprint, based on what they've provided, there is a resource for them. Now, if they don't have any income, they got low credit, and they got 5% down, they're going to have a hard time finding financing. So for that business owner, that consumer, you want to have as much net income as possible from a qualifying standpoint, and you want to have the highest scores possible. You want to have money saved up. You want to improve your chances to get approved, which, I mean, that's the whole ballgame. If you want money, you got to be able to document you have it, unless you have that rich aunt or rich uncle that just trusts you as a niece, nephew, brother, sister that will give you the money and go on faith that they know you're gonna succeed and pay them back. So, but everyone, you know what? There's always an option. Matt, I have no money and bad credit. Well, we need to find someone to lend you 100%. Is it out there? I'd probably say in the atmosphere, in the world, there is. Try to find that person. But everyone's got opportunity. But you want to improve your chances by having income, having money saved up, having high credit, and obviously the motivation, the desire to own property too, whether it be residential or commercial. So again, it's what the buyer's makeup is, and then we can assist that along the way. We can help them out. So you mentioned credit, and that's one that we can help them out too.
Okay, yeah. So I think the encapsulated version of that is that probably you're going to, if you think that you've been really lowballing your income, you might want to revise your previous year's income tax so that you have at least 1 year of income that's going to be showing the kind of numbers you need in order to get the loan.
And to that, I'd say that consumer, that business owner would need to get with their tax professional, and then they would have to create their strategy. Okay. We're in a position that when we meet with a client, okay, based on your situation, we need either 1 or 2 years worth of tax returns, and they are what they are. We validate them. We have to make sure that those returns that are provided to us have been filed with the IRS. And for better or worse, whatever they provided, we take that income and run with it. It depends it's what they have left over that they report that we get to run with. And that's conversation. Could be, you know what, Bob, you got great credit, you got money saved up, but you have a good tax person because your net income is insufficient to get you qualified. So it just depends on how they manage their tax return with their accountant, CPA, tax person. So that's on them. We just get what they get. We take that fingerprint of what they have and apply the guidelines, and we will certainly look to get them qualified for as high as possible. But if it's a business owner, they could certainly have a strategic conversation with their tax person to work on that and figure out what they want to do. But generally speaking, you make a good point. Somebody wants to buy a home and they want to put 5%, 10% down, they fit that guideline, they need the income to support that. And people will ask about that. And I'm not a tax person, so my advice is you got to talk with your tax person. You come up with a strategy, and if there's a desire to own a home, they're going to have an income that's supported from a qualifying standpoint, or go bank statements, or find that private investor. Each level, Fannie Mae, Freddie Mac, bank statement, and then you got your private investors. Which tier do you want to be in? So I would say honor the platform. You make income, you report it, you pay your taxes, you have you have substantial income, you go buy a house, take advantage of where the market's at, appreciation. Obviously nothing like home ownership in your financial world. I mean, if you're, you want to get ahead, the home ownership is going to be the cornerstone of building your worth. So yeah, choices for the consumer.
Okay, well, good. So listen, if you out there in YouTube land like this kind of content, hit like, because that'll help me know that you like it and you'd like to see more content like this. And also you want to subscribe to the channel. And if you'd like to hear more of what we do on Small Business Daily, just hit the notify bell over there and you'll get notified about tomorrow's program. So today we've been talking about something that almost every small business owner has dealt with in their life. Have you dealt with it? Put it in the comments below. We'd love to hear your story. What did you how did you deal with a situation where you really needed the money and you could use your home and you had to make some choices about using your home? Yeah. That would be a great story to tell in the comments, or ask questions in the comments, or even make suggestions about future things that we might do. So Matt, I want to thank you for coming on today and helping these small business owners to understand just a little bit more about where they might be able to find money on that day they really badly need it.
You are welcome, and thanks for having me on the show. Much appreciated. And you know what? Feel free to give me a call. Look forward to helping you folks out.
Okay, great. This is Randy Kirk with Small Business Daily, and we'll see you tomorrow.